I was very into investing as much as I could into the stock market, into broad-based index funds. And so I would, throw a lot of money into my TSP, tried to max it out like $23,000 a year or so. And I did that for the first few years of my military career. And then as I finally started to take more of a real estate approach, I felt comfortable taking some of that money out, knowing that I would be paying an interest rate that was below the market to myself, really. So I wasn't paying an interest rate to anyone else. All that money was going back into my TSP.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today's guest is Stephen Nellis. He's a family medicine doctor and Army flight surgeon who turned a personal finance hobby into a focused real estate strategy. While on active duty and even during deployment, he built a small portfolio of cash-flowing midterm rentals in the Midwest. He used tools many military professionals overlook, including VA loans and TSP loans, and moved from learning mode to execution fast. His story highlights how taking action, not chasing perfect timing, created his momentum. Stephen, we appreciate you being here today. Thank you very much for your time. How are you, sir?
I'm doing great. How are you guys?
We're doing great. Thank you for
Excited to
being
have you here.
Yeah, you're excited to have a physician, military background, and somehow with all that stuff that you're doing that must not take up any of your time, you're building a real estate portfolio on the side. So obviously you got a lot going on, which means you're probably doing it very strategically. Because of the limited time, I want to kind of get straight into your physician, Army flight surgeon. How did you decide that you wanted to complicate your life with real estate? And how did you decide to head in the direction of midterm rentals?
Yeah, so it was actually kind of serendipitous. So I'm stationed about an hour and a half from my hometown. So with my wife and 2 kids and dogs, we would travel to visit family, maybe once a month. And it was just, there wasn't any place for us to stay. So at one point I just, thought it'd be a good idea to maybe get a secondary house in our hometown, and tried to actually start it with short-term rental when we weren't there, and just kind of fell into the midterm strategy with a website called Furnished Finder, and started with one, and then kind of added, once that became successful, I've kind of added one every year since. Right now I have 3, all up in my hometown, where I will end up living when I'm out of the military as well.
So, I read a little bit about your background. I've heard an interview with you. You spent years learning about personal finance before buying your first property. Sounds very, very familiar to me. What pushed you from learning to action, and what changed once you made that first move?
Yeah. So I think I just, the fact that I have a pretty stable B2 income kind of gave me the courage, I think, to kind of step into something new, into real estate. And because, the worst case scenario in my mind was, end up selling it. I still have my stable B2 income. And I just felt at the time it was time to, actually take action for once, instead of trying to digest all the information out there from people that, have taken action.
Yeah, making that first step, that first action step is usually the hardest one. That analysis paralysis that sets in, that, eventually you get to the point that imperfect action is better than perfect inaction. And it's really that first step that kind of gets you rolling. I want to ask you this. Your situation is pretty unique because your time is so limited. I mean, kids, dogs, career, medicine, military, everything else. My suspicion is you're probably buying properties that are turnkey and ready to go. Or are you focusing on buying properties that do need renovation, and you're trying to get value add so that you can create enough forced appreciation to refinance and recapitalize, pull money out? Or is it to the point that your time is so valuable that it's worth just finding a decent deal, paying a little bit more, and just go ahead and getting the property, getting it up and running, and then just recapitalize by keeping the main thing, and getting paid back through your job? How are you scaling?
That's exactly right, actually. So I look for properties that have already recently been flipped or was being used as an Airbnb short-term rental previously. I look for those properties, and for every property I've actually bought, they've also included the furnishing. I've also made that part of the deal. I'm lucky enough to have a cousin who's a real estate agent, and she does property management for me. So it's really good to have her on my team, and she does a lot of the groundwork and helping me buy the properties, inspect, and then also get that furnishing in there.
There's one common denominator that I have seen, I think every time I've talked to somebody working on midterm rentals, is that they backed into the strategy. I don't know of anybody who's like, you know what I'm going to do? I'm going to grow a midterm rental portfolio. So my wife and I have had 4 Airbnbs. We just recently got rid of one of the quadplexes and we're down to 10. But when we first started buying multifamily properties and converting them to Airbnb in the market where we are, which is a small beach town, there was 1,128 active listings on that island. The next year there was 1,250, then 1,550, then 1,750, then 2,300, then 2,600, and then eventually over 3,000 before it got saturated. And now it's falling drastically because the performance is not there because the supply was greater than the demand, with the exception of just the peak season. And so a lot of people bought using the bad data that came out of those 2 amazing years of short-term rentals that we had right after COVID, when everyone was location independent and everyone had stimulus money. Well, all of a sudden, everything came crashing back down to earth, and the people that weren't making the deals pencil, a lot of them in areas that made sense, flipped to midterm rentals. And the few people that are doing that really well have stayed in that, because the one thing about short-term rentals that you can't control is if it's in an area where you're allowed to do it, you can't control how many other people are doing it. If it's an area that you have to have a permit and you're grandfathered in, that's actually a good thing in my mind because it creates exclusivity. But if anybody can do it, you may buy something as an Airbnb, or in your situation, you have people selling an Airbnb because those numbers likely are not what they expected them to be when they bought that property in 2023. It's just not there. And so these people have backed into this midterm rental. That strategy is a lot less work than short-term rentals, because instead of 6 to 8 tenants per month, you end up with 1 tenant sometimes for 6 to 8 months. It's usually more like a month to 3 months, something like that. The interesting thing is finding that tenant and being in a market where it makes sense. So a lot of times that's travel nurses in Wilmington, North Carolina, where we live. A lot of times it's the film industry and people coming to town for a month or 2 at a time. What is it about your hometown that makes that strategy work when short-term rentals wasn't working as well for the people in that community?
Yeah, so I'm from Evansville, Indiana. So it's a relatively it's the third largest city in Indiana, but it's not huge by any means, not a metropolitan area. But what it does have 2 major hospital systems, and so yeah, definitely travel healthcare is a big one. Also, they're always building stuff there, so the construction. I find that a lot of the times, a lot of my tenants end up being electricians, trades workers that are there that are contracted for a job. And then another interesting piece with midterm rentals is you get a lot of insurance companies that whose people even in the area who have been displaced by a fire, flood, and need about 3 months to 6 months for the repairs on their home. The insurance company, they look for midterm rentals and to kind of put the family up in a location that's still nearby and can kind of give them what they need instead of doing like a hotel or something like that.
So are you looking at it differently than an Airbnb investor would? Like, is there a certain bedroom formation, a certain yard formation, fenced in yard, garage, like obviously washers and dryers, encouraging longer stays? Like, what are the metrics that you're looking at to know that something's going to be a strong midterm rental?
Yeah, so I do look at those sort of things. I kind of look at it as I would maybe like a long-term rental, as far as when I would want, like the place that I would want. So most of mine are 3 bedroom, 1 to 2 bathroom, fenced in yard, garage, basically, because in my mind, a midterm rental is the best of both worlds for a short term, between a short term and a long term rental. The tenants, they're going to be there for an extended period of time. A lot of times they're working. It really is, their home whenever they're not working. So they treat it like their home. It's not going to be kind of like that churn and burn of the short-term rental. but it's also not going to be someone that's, kind of there, maybe like neglecting some of the stuff that may have a 2-3 year lease. So I find that that's what I look for is a place that I'd want to stay if I was working as a medical student. You go places for a month, 2 months, and work there. So I'm kind of looking from that aspect of it.
So you used a TSP loan. So I've got two questions on there. First of all, I'm going to have to ask you what a TSP loan
That was
is.
my question too.
I'm stealing it. And then walk us through how you evaluated that decision and the risks that you focused on before pulling the trigger on those three properties.
Yeah, so TSP is basically the military's form of a 401k, and a TSP loan is similar to a 401k loan. So you pull it out at a specific interest rate that is typically the bond fund market that is in the TSP is the interest rate, and then you have a certain time to pay it back, and it comes out of your paycheck every month. So and you usually have between 5 to 10 years to pay it back. I've taken out about 4 TSP loans and I've paid them all back within a year. And I think my thought is because I think my journey kind of evolved from initially when I started. I was very into investing as much as I could into the stock market, into broad-based index funds, and so I would throw a lot of money into my TSP, tried to max it out like 23,000 a year or so, and I did that for the first few years of my military career. And then as I finally started to take more of a real estate approach, I felt comfortable taking some of that money out, knowing that I would be paying an interest rate that was below the market to myself, really. So I wasn't paying an interest rate to anyone else. All that money was going back into my TSP. And I felt that it was a safe bet. And I just kind of bet on myself that I'd be able to pay it back, pick up some extra shifts, moonlighting. And I've been able to do that.
Were you, just understanding the mechanics here, were you buying the properties 100% with the money from your TSP loan, or were you combining it with a traditional loan?
Yeah, all my properties have been combined with actually traditional mortgages. My first 2 were secondary home mortgages. So my initial one, was 10% down, and then I used the TSP loan to kind of help with the down payment and the closing costs. I was able to do that again with my second one as my family got bigger. We were able to make it work to say, we need a bigger property to stay, and so they were able to do that. And then the third one, I actually put 20% down and just got a traditional loan. So, I would say I'm decently leveraged in these deals, but I just kind of have faith in the appreciation and the cash flow that that's occurring, and as well as the fact if I wanted to, I could just pick up more shifts and I'd be okay. So I think that's kind of I know not everyone has that luxury. I think, as someone who's a high income professional, trying to moving towards real estate and just kind of knowing that you have that backstop is helpful just to make
and one of the things is like single family properties like this is oftentimes a very slow way to get ahead, but it's a great starting point, and it keeps your equity tied up for a long time and continues to build over time. And in something like this, a lot of physicians, you guys have you could save your way to retirement. Very few people can do that anymore. You could save your way to retirement, but a lot of times it's hard to keep up with that lifestyle creep. The best thing in my mind is what you're doing is playing offense, and it's investing your way to retirement if that's what you decide to do. And you also have, with the new tax bill that was signed into law, you have the ability to tap into a lot of accelerated depreciation at some point in the future if you decided to do cost segregation studies and take that. But my question for you, Dr. Nellis, is you are heading in a direction where over time, you are going to have less and less time, and your time becomes worth more. as you're moving down your white coat professional healing career and helping a lot of people and changing a lot of lives, your time becomes more and more valuable, not just because of what it's worth as a physician, but because of what it's worth to your family. And so a lot of times in that role, we see people moving up to bigger projects where you realize, look, any real estate project I do takes up a certain amount of my mental time and my mental energy. So if I'm going to take a bite, I might as well take the biggest bite that I can. And I looked originally at single family homes as a destination. And then I realized it was a stepping stone to small multifamily. And I looked at that as a destination until I realized that was a stepping stone to converting those to Airbnbs, and then converting that to property management, and then getting burned out on tenants, and then moving to storage. So question for you is, what's next? What do you think is your destination? And as you're heading down a career path where traditionally we see real estate investors just keep rising to the occasion and taking bigger and bigger steps, and we know you're probably going to have less time. Your time is going to be more valuable. What do you think is coming down the pipeline for you, and what are you looking at in the future?
Yeah, thanks for that question. It's a good segue. So, I actually first heard of your podcast on another podcast. I heard you talking, Clint, on Alex Schlow's Physicians and Properties podcast.
Yeah.
And so I know Alex. He was a family medicine physician. He is a family medicine physician. He's in the Air Force, or he was in the Air Force. So yeah, and I actually just invested in one of his projects, one of his syndication projects. So
Nice.
I think that's probably where I'm headed. I've seen a lot of different options. There's farmland. The self storage that you guys do is, I've been looking into that. Nomad Capital. It's awesome. And yeah, I think I'm likely going to be switching to more syndications, more hands off. I do enjoy right now what I'm doing with the midterm rentals. But yeah, if I'm going to move to more of a passive income, then I think that's the next step.
Well, it's such a, Clint and I talk about this all the time, of what a sort of a cliche of a journey it is. I'm not calling you a cliche. Clint and I are both examples of this cliche, is where you start off in single family homes, and then you move to, maybe a small multifamily, and, maybe you get more exotic strategy. You jumped right into the midterm rental strategy.
Yeah.
And then, like Clint says, eventually your time becomes worth more than whatever you're making from the passive strategy, and we talked about this beforehand, is, there's no such thing as truly passive income. That's kind of the joke of our podcast. And the passivity of something becomes more and more important. And eventually, I invested in syndications even before I started syndicating on my own. And it's sort of a natural progression, and especially as you start to earn income, either from your main thing or from your side hustles, like these midterm rentals and things like that. And it's just a very natural progression.
Yeah. And it's not always linear, right?
No.
It starts off that way, but here's the thing. It's the same story that we see a lot of times, but the thing that's different is the fundamentals are the same, but the way that people take those fundamentals and apply them is wildly different. Some people look at your skill set, like it may be raising capital, underwriting deals, whatever it may be. But at the end of the day, finding the deal, funding the deal, understanding the dynamics of the market, forced appreciation, and then recapitalization is the hard part. Recapitalization is really hard for a lot of people. They have to find a way to pull equity back out of the deal. You're going to be in that unique scenario where you can fairly rapidly save your way to repaying a TSP loan and continuing to scale and move forward. So I love that. And it's not going to take you too long before you're getting to the point of where that cash flow is generating what you need to continue to invest in syndication. Let me ask you this, because this is something that we see a lot. The average investor that we come in contact with that is investing in syndication for the first time has finally gotten to the point, usually after 20 years of active investing, they get to the point where their time is worth more than anything else. And they are usually like 54 to 58 years old. You are obviously a lot younger than that, and you're well ahead of schedule than we typically see. But that first investor a lot of times is like, ooh, that looks good. Let me go for that. I like this deal. That's shiny. This ad looks good. I like the way that guy sounded on the podcast. And Neil and I are of the opinion that most of the time that syndication investing is done backwards. A lot of what I think is that people should establish the goals that they have for their family, with their wife, their husband, their spouse, whoever. Figure out what you're trying to do, because there's nothing on a piece of paper that makes a deal a good deal. What makes a deal a good deal is if it fits in with the goals that you have for your family and what you're trying to accomplish for your children. So when you were looking at getting invested with Alex, I think you picked a solid person, like in terms of character, morality, ethics, communication, the important stuff. How did you and your wife look at that opportunity and make that decision? Did you have those conversations, or what did it look like for you? Give us your personal anecdotes about that.
Yeah, so the deal we invested in, it's a residential assisted living. So it's something that I think not only is going to be profitable, but it's something that I think really helps, is needed and will be helpful. So I thought it was kind of really the best of a bunch of worlds. I knew Alex. I knew he, great person, right? We have similar values. I looked at the deal. It looked like, definitely something that was needed. And, it's definitely seemed like something that I could feel comfortable putting my money in, and just kind of watching it grow, hopefully, and help the community. I will say this, I did kind of, take a shot with it. And I basically told myself, if, for my initial one, if I'm going to pretend like I just lost, $50,000 or however much it was, and then I'm really going to, hope it does well and kind of go from there. So yeah, I think that in addition to just kind of diversifying my income streams, I just wanted to kind of jump into the syndication world, and with someone I trust, and with a deal that looked good. But yeah.
It, we talk about this all the time, is that risk is a muscle. And, you're very rarely going to see someone who was maybe only investing in low cost index funds, and all of a sudden they discover syndications and they jump right into investing in syndications. It's usually going to be somebody who at least has some experience with real estate and has exercised that risk muscle a little bit like you have, and discovered that, oh, I can use leverage to buy a physical asset that's going to cash flow, and maybe not a lot, but it's going to, at some point it's going to cash flow and the appreciation is going to take over. And I can do that. And I did it, and nothing bad happened. I didn't fall on my face, and then that sort of, you do it again, you go, okay, I did it again. Nothing bad happened. And then you do it again. And then, like we said, eventually, and that's why, I think I think you're coming at it from a good mindset, which is, listen, this is money that I'm willing to risk, and I doubt you're going to lose the whole money, but that is a risk you take with a syndication. You are taking a bet on another person to execute a business plan that's going to hopefully end up making you money. But obviously you knew this person beforehand. And I think it's often a better way that people approach this. Sometimes people kind of find a strategy, and they go out and they look for someone who's doing that strategy, when I think oftentimes it's better to find someone who's doing something and has done something successfully. And then, whatever it is, if it aligns with what your family's goals are, then
you're also betting on the jockey, not the horse, right? It isn't you're looking at the deal. The deal, honestly, let's be honest, it's kind of in your wheelhouse. Like, you understand the dynamics of the silver tsunami that's headed our way and everything that's coming along with that. So, like, I think you can speak to that, and it makes sense. You see the demographic shift, but at the end of the day, like, you're investing into something with a person that you're betting on the jockey and not the horse. And in that situation, it's like you create a partnership with someone that like and trust, and you can continue to invest with them over and over. I think that's so much more strategic than being like, well, let's diversify across assets, right? A lot of people diversify across different asset, different geography, and different operators. But over the last few years, we saw people with all their money in multifamily. It may have been spread out across the country, but all of them got hit with the same interest rate increase at the same time at the end of 2022 that really laid a lot of people flat and exposed things. So starting with the right person in mind, betting on the jockey instead of the horse, I think is brilliant. Do you have do you have ambitions of creating diversification as you're looking to do more passive investments in the future? Have you put thought into that? What does that look like for you?
Yeah, I have. Still, early in my journey, so there hasn't been anything that I've really, I don't have like a niche yet other than my small midterm rentals, but I'm kind of in the process right now, just kind of looking at the different options and seeing like things that I feel one, would be a good option to increase my wealth, but also things that I would be happy to be invested in. Things like the deal that I was talking about with the residential assisted living, uh, things like farmland, stuff like that, just things that I think are beneficial to the public.
I love that. I think we're catching you early in this journey, and it's going to be really interesting to see how it changes over the next few years. Cause I kind of feel like you're probably on this midterm rental lily pad, but you're making a jump, right? And you jumped to a veteran strategy, by the way. Like midterm rentals is not a entry level strategy that a lot of people find. So like you can blame yourself for these years of like just building up the financial acumen before you finally got the courage to like take a jump. But let's be honest here, like the first move that you made is a little bit more of an advanced strategy. And there's a lot of really cool lessons that come along with that. Some of the lessons sometimes are like, wow, I really hate this because of the amount of tenants that I have. That's one of the experiences that I had, not from having a few Airbnbs or even from having 10 or 14 Airbnbs. It was from a property management company. And then it was like, boy, when you multiply the amount of work here times 75, it's different, right? But the fundamentals and the lessons are there that really help you take that step forward. So I think it's going to be very interesting to follow your journey over the next few years. And I think the one constant is going to be change, which is no surprise, right? There's very few people that start off with a strategy that stick with it, especially a strategy that hasn't been midterm rentals have been around for a long time. But I think because of Furnished Finder, they're much more mainstream now than they ever have been. And even though it was a bailout for a lot of people that short-term rentals weren't penciling, a lot of people have found refuge there. And it's a pretty sweet spot, especially if you're in a market where it makes sense. And a lot of times, some of these tenants like pass it from one to the other, or you get a corporate rental and they're just continuing to put people in there one after the other. If you got a GC that's got a big construction job there. So it's a sticky asset class. If you have a good unit that's renting out well, sometimes that tends to stick with people and your occupancy is pretty high. And the end result is it almost feels like a long-term rental. You're just getting a 30% premium on your rate. So I love that too. I think you're heading in the right direction. It's going to be interesting to check back in. And I'm glad you're recording this to have something to look back on for posterity. For the sake of time, we do have to land this plane. In your experience, you're talking to other people about this. You're talking to Alex, your friend, your wife, anybody else. And as you're entry level getting into this, and you got 3 of these properties, I know you're having conversations at the scrub sink or the hospital or wherever else about this. When other people ask you about what you're up to, is there any one book or resource that you find yourself recommending to friends or family more than any other?
Yeah, so I'll say, kind of like for the medical professional specifically, which is kind of in my realm who I usually speak to, I will usually recommend the White Coat Investor. It's a good entry level book to kind of get your it's more personal finance based than real estate and kind of get yourself right. And just in general, I really like the book Die with Zero. I think it kind of puts in perspective, it's more about the journey than the destination. So, definitely you should try and set yourself up, with investments and everything, but don't look too far ahead at the destination. Try and enjoy the journey as well.
Love that. Could not agree more.
Yep.
All right. Dr. Stephen Nellis, Thank you so much for being here. We appreciate your time. We appreciate your service to our country. Thank you very much for that, everything that you're doing there, and your service to your patients as well. So appreciate your continued efforts to give back to our community and to our nation. If any of our listeners want to follow your journey or hear more about you, even if it's just following you on social media or anywhere else, what would be the best way for people to connect and continue to watch what you're up to?
Yeah, so really, I'm just on Facebook for social media. But if you want to look me up on there, and then please, if you have any questions, you can send me an email, stephen.m.nellis@gmail.com. I'd love to connect, and I think a lot of this is about networking. I've kind of got to you guys through my own podcast journey through the different podcasts, and I think networking is huge. And so, if I can help anyone that's in my position or anything else, I would love to.
I love that. Well, thank you, Stephen. I agree with you. The R word that people think we're talking about is real estate, and I disagree. I think it's relationships. So I appreciate that. Thank you for your time and your efforts, and for being with us today. Thank you so much. We look forward to continue to follow your journey.
Thank you, guys.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode. Leave a comment down below or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.